Hey everyone, and welcome to The Explainer. Today, we're pulling back the curtain on one of the most fascinating and, frankly, misunderstood environments in all of modern finance. We're talking about the deep ocean of crypto markets. We constantly hear about massive market swings, sudden drops, and these crazy unexpected surges, right? But who is actually behind them? Well, today we're going to explore the tools and the data that let us track the absolute biggest players in the game, and we're going to completely unmask their movements in real time.
Okay, let's jump right into this. 1,000 Bitcoin. That right there is the magic number. You see, in the traditional financial world, a large investor might be a hedge fund managing billions. But over in the crypto space, we have a very specific threshold for what we consider a true market mover. Now, there isn't an official dictionary definition or anything, but generally speaking, if a wallet holds 1,000 Bitcoin or more, they are classified as a whale. This staggering amount of capital gives them the raw power to literally shift the market with a single click of a button.
I want you to think of the crypto market as this vast, dark ocean. Retail investors, most of us, we swim near the surface. But lurking way down in the deep water are these giant entities moving massive, massive amounts of wealth completely unseen. Or actually, scratch that. They think they're unseen. As we'll see today, on-chain data acts as our ultimate sonar. We can ping the depths of this ocean and see exactly who's moving, where they're going, and what they're probably going to do next.
So, here's our dive plan for this explainer. First, we'll meet the crypto whales. Second, we're unmasking the wallet tags. Third, we'll learn how to actually read the whale alerts. And fourth, we'll wrap up with why whale tracking really matters.
All right, part one, meet the crypto whales.
So, beyond that 1,000 Bitcoin threshold we just talked about, the functional definition of a crypto whale is simply a wallet holding a large enough amount of coins that their transactions create literal, visible ripples in the market. Now, keep in mind, while 1,000 BTC is the standard for Bitcoin, this scale obviously adjusts depending on the asset. For smaller altcoins, a whale might hold a lot less in total dollar value, but because the market cap of that specific coin is smaller, their holdings represent a massive percentage of the available supply. So when they move, the entire chart feels the impact.
To effectively track these giants, we really need to calibrate our sonar. We can't be distracted by every tiny little fish swimming by, right? So the baseline data we're looking at tracks a very specific minimum transaction size, $500,000. Any single transfer above $500,000 triggers an immediate alert. That's our baseline for a move that demands attention, because it ensures we're only tracking entities with real, undeniable market-moving muscle.
But here is the most fascinating part of this whole ecosystem. The true weakness of these financial giants is actually the very technology they're using. The blockchain is a public ledger. Because of on-chain visibility, every single transfer they make is recorded forever. There's no way around it. They cannot hide their massive transactions from our tracking bots. Unlike traditional Wall Street, where dark pools and closed-door trades can totally conceal big moves, in crypto, if you move $500,000, the blockchain broadcasts it to anyone who knows how to listen.
Which brings us to Section 2, unmasking the wallet tags.
Now, what's really interesting here is the breakdown of this rogues gallery we've got lurking in the crypto ocean. Exchanges make up the absolute largest chunk of tracked whales. But right behind them is this massive segment of mysterious, unknown holders. You've also got your custodians, ETFs, and market makers. And the thing is, every single one of these categories behaves differently. Applying the correct tag to a wallet is exactly how we start decoding their true intentions.
Let's break down the major institutional players, the real bullish and bearish movers. Identifying these tags gives us an immediate edge. For exchanges like Binance or Coinbase, the rule of thumb is pretty simple. Money flowing into the exchange is generally bearish because it means they're preparing to sell. Money flowing out, that's bullish, indicating accumulation. Then you have the ETFs like BlackRock or Grayscale. When money flows into an ETF wallet, it is a strong bullish signal. It means institutional investors are buying shares. Custodians like BitCo usually represent long-term institutional storage, and crypto funds like Fasanara are the active traders. Their massive directional moves often precede major market shifts by a matter of hours.
But then, you have the wild cards, the ones that can send total shockwaves through the market in seconds. Take government wallets. If a wallet holding seized assets shows an outflow, it almost guarantees massive immediate sell pressure. Corporate treasuries like Tesla or SpaceX holding Bitcoin provide immense credibility, and their sells are incredibly rare but highly impactful. And then there's the hacker tag. Wallets linked to known exploits like the MT Gox hack are watched by literally everyone. The second one of these wakes up, it is a code red market alert. Finally, we have the unknowns. Massive holders we can only really figure out by intensely studying their historical movement patterns.
I want to pause here for a second, because this concept perfectly encapsulates the whole logic of whale tracking. Knowing the tag changes everything. The same $50 million transfer means something completely different depending on who sent it. Think about it. A $50 million move from an exchange to a cold wallet means someone is locking it up for the long haul. But that exact same $50 million moving from the US government to an exchange, that means a massive dump is imminent. The raw data point is identical, but the context is absolutely everything.
Moving into Section 3, Reading the Whale Alerts. And this brilliantly illustrates the most fundamental rule of whale tracking, knowing the difference between an inflow and an outflow. Just think about the mechanics of it. If a whale wants to sell their crypto, they usually have to move it from their secure offline cold storage onto an active exchange where the buyers actually are. That's an inflow, and it creates selling pressure, which is bearish. Conversely, if a whale is buying up crypto on an exchange, they're not going to just leave it there. They withdraw it to a secure private wallet. That's an outflow, signaling accumulation, which is highly bullish.
Of course, not all splashes are created equal, right? When our sonar pings an alert, it categorizes the actual size of the wave. On the low end, a $500,000 to $10 million transfer is just a small to minor move. It's interesting for sure, but maybe not market-altering. Once you cross into that $10 to $50 million range, okay, now you have a notable to significant event. 50 to 100 million, now we're talking about a strong to whale move that is definitely going to impact price action. And anything over $100 million, that's a mega whale, a literal tsunami in the data that every trader needs to be intensely aware of.
So what does an actual live alert readout look like? Well, here is the anatomy of the data you'll get. First up, you'll immediately see the movement size classification we just talked about, something like significant move. Second, and honestly most importantly, you'll see the direction. Is it going to an exchange, from an exchange? Is it just a neutral transfer between two unknown wallets? And finally, you get the exact value conversion, taking the live US dollar amount and showing you the precise amount of Bitcoin that was shifted. It's essentially your very own sonar readout, delivered the absolute second a block is validated.
And finally, Section 4. Why whale tracking matters.
So the crucial point here is this. Tracking whales gives you a definitive on-chain edge. First, it provides a vital early signal. It takes time for massive sell orders to be absorbed, meaning whale moves happen on the blockchain before the actual price chart fully reacts. Seeing a $50 million exchange inflow gives you that critical window to reconsider your own positions. Second, it gives you context. If the market suddenly drops 3% out of nowhere, was it a coordinated sell-off by a whale or just everyday retail panic? The blockchain will tell you. And third, it's the ultimate sentiment check. If you see consistent week-long outflows from exchanges, it confirms that institutions are quietly accumulating, regardless of what the daily news headlines might be screaming.
The blockchain is a completely open book, provided you actually know which pages to read. You are no longer flying blind in the dark ocean of cryptocurrency. These giant entities moving the markets, they leave a permanent trail of data right in their wake. So I'll leave you with this. The next time the crypto market suddenly drops 3%, are you going to panic and follow the crowd? Or will you check the sonar and see what the whales are actually doing? Thanks for joining me on this explainer. Keep your eyes on the data and keep learning.